Do you know that one of the greatest investors in history spent his career telling people that the secret to success was not finding the right stocks, it was building the right mind? That Charles Munger's approach to wealth, to business, and to life was built not on financial formulas, but on a latticework of ideas drawn from physics, psychology, biology, history, and mathematics. This is what Poor Charlie's Almanack teaches, and why the thinking inside it is more valuable than any stock tip. This video is for educational and informational purposes only and does not constitute financial advice. The ideas here are framed in original language for educational discussion. Chapter 1. The man Charles Thomas Munger was born in Omaha, Nebraska in 1924. He grew up during the Great Depression in a household that valued intellectual discipline and hard work. His grandfather was a federal judge. His father was a lawyer. The expectation in the Munger family was that you read, you thought carefully, and you developed your reasoning before you spoke. He studied mathematics at the University of Michigan before his studies were interrupted by the Second World War, during which he served in the U.S. Army Air Corps, reaching the rank of second lieutenant. After the war, he applied to Harvard Law School without an undergraduate degree, an arrangement that the post-war admissions process permitted for veterans of demonstrated ability. He was accepted, passed the admissions interview reportedly by impressing the dean with his reasoning, and graduated magna cum laude in 1948. He practiced law in Los Angeles, establishing a firm that is now Munger, Tolles, and Olson, one of California's most distinguished law practices. He was successful at law, building a reputation for clarity of analysis and directness of expression that characterized his communication throughout his career. But law was never his primary vocation. His primary vocation was thinking. He read voraciously across every field he could access: history, science, mathematics, psychology, biography, literature. He read with the explicit intention of accumulating what he called mental models, frameworks from different disciplines that could be applied to problems across the full range of human activity. He met Warren Buffett in 1959 at a dinner in Omaha. Both were young men in their early to mid-30s. Their connection was immediate and remarkable. Buffett later said that talking with Munger over the years changed his entire approach to investing, moving him from Ben Graham's model of buying mediocre companies very cheaply to buying excellent companies at a fair price. This shift, which Munger drove through argument and example, was responsible for a significant portion of Berkshire Hathaway's extraordinary subsequent performance. Munger joined Berkshire Hathaway as vice chairman in 1978 and held that role for more than 40 years. He died in November 2023, 1 month before his 100th birthday. His wealth at death was estimated at approximately $2 billion, largely accumulated through Berkshire Hathaway, through a philosophy that prioritized extraordinary patience and the discipline to buy excellent businesses and hold them indefinitely. Chapter 2. The book. Poor Charlie's Almanack was compiled by Peter Kaufman and first published in 2005. It is a large format, lavishly illustrated volume containing Munger's speeches, letters, and talks from across his career, along with commentary from those who knew and worked with him. An expanded and updated edition was published in 2023, shortly after Munger's death. The book is expensive, substantially more so than an ordinary business book, physically heavy, and unlike almost anything else in the investing literature. It contains almost no stock tips. It contains no trading systems. It contains no formulas for identifying undervalued securities. It does not tell you what to buy. What it contains instead is a systematic account of how Charlie Munger thinks, the mental frameworks he uses, the mistakes he tries to avoid, the psychological tendencies he watches for in himself and in others, the principles that have guided his decisions across a career spanning 7 decades. The book's title is a reference to Benjamin Franklin's Poor Richard's Almanack, the collection of aphorisms and practical wisdom that Franklin published through most of the 18th century. The homage is deliberate. Munger, like Franklin, believed that the most important things anyone could acquire were mental tools. Ways of thinking that improved decision quality in any domain, not just the specific area in which you happen to work professionally. The speech that is the centerpiece of the book, The Psychology of Human Misjudgment, was developed over decades and delivered in its most complete form at Harvard Law School in 1995. It is one of the most systematic attempts any practitioner has ever made to catalog the cognitive biases that produce poor decisions, explain their evolutionary origins, and describe how they interact in real-world situations to produce outcomes more irrational than any single bias would produce alone. Chapter 3. The latticework of mental models. The central concept in Munger's intellectual framework is the latticework of mental models. Munger observed that most educated people operate with a small number of mental models, frameworks for understanding and analyzing the world. A lawyer thinks primarily in legal categories. An economist thinks primarily in economic categories. A doctor thinks primarily in medical categories. When a problem arises that does not fit neatly into their primary discipline, they apply their familiar tools anyway, sometimes successfully, sometimes catastrophically. Munger called this the man with a hammer problem. If the only tool you have is a hammer, you tend to treat everything as a nail. The result is systematic distortion. Problems that require scalpels being addressed with hammers, solutions that require careful nuance being replaced with blunt instruments. His solution was to build what he called a latticework, a cross-disciplinary collection of mental models, each drawn from the foundational principles of a different field. Not an encyclopedic knowledge of each field, but a working understanding of the key ideas. The ideas that have proven most durable, most broadly applicable, and most illuminating when applied outside their original context. From physics, he drew concepts including equilibrium and the idea that small differences in conditions can produce dramatically different outcomes near tipping points. From mathematics, he took compound interest, probability theory, and the significance of statistical base rates. From biology, he borrowed the concept of ecological natures, that successful organisms and successful businesses occupy environments where their particular characteristics give them an advantage that is difficult for competitors to replicate. From psychology, he took the systematic catalogue of cognitive biases that his study of academic research had produced. The latticework is not a fixed collection. It grows as you learn. What distinguishes Munger's approach is the deliberate breadth of the construction, the recognition that problems in the real world do not respect disciplinary boundaries, and that the person with the widest range of applicable frameworks will produce better decisions than the specialist constrained by a single discipline. Chapter 4. Inversion. The first of Munger's most important mental models is inversion, which he drew from the mathematician Carl Jacobi's principle. Invert. Always invert. The standard approach to achieving a goal is to think about what actions will lead to that goal. Inversion asks the opposite question. What would prevent you from achieving that goal? What conditions would guarantee failure? What behaviors would ensure the outcome you want to avoid? Munger applied inversion to investment analysis, to business assessment, and to life decisions. Rather than asking how to build a successful business, he would ask what a guaranteed failure would look like, then work backward to ensure he wasn't building that. Rather than asking what makes investors successful, he would ask what makes them fail predictably, and identify the failure modes first. Inversion is powerful for several reasons. It forces you to consider risks and failure modes that forward planning easily overlooks, because forward planning tends to generate narratives of success rather than catalogues of failure. It reveals necessary conditions rather than sufficient ones, what must be true for the goal to be achievable rather than what might be true if everything goes well. Munger's application of inversion to investment included the question, what would I have to believe about this business for this price to be justified? This forces the analysis backward from the price to the assumptions it implies, rather than forward from the business characteristics to a price. The assumptions that the price implies are often much more demanding than a forward-looking analysis would generate. Chapter 5. The margin of safety. The concept of margin of safety originated in Benjamin Graham's work on security analysis. The idea that an investment should be made at a price significantly below the investor's conservative estimate of the underlying value, so that errors in the estimate do not produce losses. Munger absorbed this concept from Buffett, extended it, and applied it far beyond securities analysis. He treated margin of safety as a general principle of decision-making under uncertainty. Whenever possible, build in a buffer between what you need to happen and what must happen for your position to be untenable. A bridge designed to hold 30,000 kilograms that will only ever carry 10,000 kilograms has a margin of safety. A business that can generate sufficient cash to service its debts, even if revenues fall by 30%, has a margin of safety. A career plan that still works if the primary outcome doesn't materialize, because the secondary outcomes are independently valuable, has a margin of safety. The margin of safety is not about pessimism. It is about the recognition that real situations contain more uncertainty than any analysis can fully capture, and that operating without a buffer means that ordinary errors become disasters. In investment, the practical application is straightforward. Buy excellent businesses at prices that provide a genuine margin of safety below your conservative estimate of intrinsic value. This means not paying for optimistic projections. It means not paying for the best-case scenario. It means paying a price at which even a moderately disappointing outcome still produces acceptable returns. The requirement of a margin of safety naturally constrains the number of investments that will qualify at any given time. This is, in Munger's view, a feature rather than a bug. The fewer the opportunities that meet the margin of safety requirement, the more valuable each one that does. Chapter 6. The Lollapalooza Effect. One of Munger's most distinctive contributions to the analysis of irrational behavior is the concept he called the Lollapalooza effect. Munger observed that many of the most dramatic examples of human misjudgment, historical financial bubbles, corporate disasters, cult behavior, market panics, cannot be explained by any single cognitive bias or incentive. They are produced by the interaction of multiple biases and incentives, all pointing in the same direction simultaneously. When several biases and incentives align, when social proof, commitment bias, incentive-driven bias, and authority bias all tell you the same thing, the result can be a level of irrationality that is qualitatively different from what any individual factor would produce. The biases multiply rather than add. The resulting behavior can be extreme, sustained, and virtually immune to contrary evidence. The Lollapalooza effect explains financial bubbles better than any single factor account. In a speculative bubble, social proof, everyone else is buying. Authority bias, expert endorsers. Commitment bias, people who have invested publicly cannot easily change direction. Availability bias, recent price increases make further increases feel normal. And powerful incentives all align. The combination produces the extreme collective behavior that looks, in retrospect, obviously irrational, but that is very difficult to resist from inside while it is happening. The practical implication of the Lollapalooza concept is that the situations most worth worrying about are not those where a single bias is operating, but those where multiple forces align. When you find yourself in a situation where social proof, authority, incentives, and your own emotional state all point in the same direction, the probability that you are about to make an error increases substantially. The aligned forces are not confirming the wisdom of the action. They are describing the conditions for a potential Lollapalooza. Chapter 7. Circle of Competence. The concept of circle of competence is simple to state and difficult to practice. Every person has a domain in which their knowledge is deep, tested, and reliable. A domain where they have accumulated genuine expertise through sustained engagement, and where their judgments are calibrated against real-world feedback. Outside that domain, they are operating on less solid ground, even when they feel confident. The problem is that feeling confident and being right are not the same thing. The unfamiliarity of a new domain does not feel like ignorance to the person entering it. It often feels like a fresh opportunity, a new area where prior knowledge and general intelligence will apply, where the absence of specific expertise is a manageable handicap rather than a fundamental disqualification. Munger was rigorous about knowing where his circle of competence ended. He and Buffett frequently and publicly declined to analyze or invest in technology companies during the late 1990s, despite the enormous enthusiasm and apparently obvious returns available in the sector, on the grounds that they did not understand technology businesses well enough to make reliable judgments about their long-term competitive positions. This willingness to abstain was striking in an environment where virtually every other major investor was committing capital to the sector. It was also, in retrospect, one of the most valuable demonstrations of the circle of competence principle. Berkshire Hathaway substantially avoided the losses that accompanied the dot-com crash because Munger and Buffett refused to operate outside their circle. Expanding the circle is possible and valuable, but expansion requires genuine learning, actual engagement with the material, actual experience with the domain, actual calibration of judgment against real outcomes. The feeling of having understood something is not the same as actually understanding it. Chapter 8. Avoiding stupidity. One of Munger's most counterintuitive ideas is his assertion that the primary goal of clear thinking is not to be brilliant. It is to avoid being stupid. This sounds modest. It is actually radical. Most frameworks for improving decision-making focus on finding the right answer, the brilliant analysis, the clever insight, the overlooked opportunity. Munger's argument is that this is the wrong starting point. The human mind is prone to a large catalogue of systematic errors, and those errors are responsible for most of the major mistakes that people make, in investment, in business, and in life. If you can identify the primary sources of error and systematically avoid them, you will make better decisions than most people. Not because you are smarter, but because you are committing fewer errors. The person who is right 70% of the time and wrong 30% of the time in ways that are not catastrophic will, over time, outperform the person who is right 90% of the time, but whose 30% errors are devastating because they were not anticipated. This is the logic behind Munger's emphasis on checklists in decision-making. Before making a significant investment, he would work through a systematic review of the primary ways such decisions go wrong. Am I looking at this through the distorting lens of social proof? Am I anchoring on a price that was paid rather than what it is actually worth? Am I confusing confidence in a compelling story with confidence in a likely outcome? Am I operating inside my genuine circle of competence? The checklist does not guarantee the right answer. It dramatically reduces the probability of the most common wrong answers. This is a more modest but more achievable goal than brilliance, and over time, it compounds. Chapter 9. The Psychology of Misjudgment. The Psychology of Human Misjudgment. Munger's catalogue of cognitive biases and psychological tendencies identified 25 distinct sources of error in human reasoning. Several of these are particularly significant for financial decision-making. Incentive-caused bias. People see what they are paid to see. The financial advisor whose compensation depends on selling products will see those products as appropriate for their clients. The CEO whose bonus depends on reported earnings will see the accounting choices that maximize reported earnings as reasonable. The analyst employed by a firm that also underwrites securities will see those securities as attractive. Understanding incentives is the essential first step in evaluating any recommendation or analysis. Denial and avoiding bad news. People have a strong tendency to avoid information that threatens their existing commitments and beliefs. An investor who has publicly committed to a position, or who has held it long enough that the holding has become part of their identity, will resist information that suggests they are wrong. This bias means that the corrections that are most needed often arrive latest, because the resistance to accepting them is proportional to how invested you are in being right. Social proof. In conditions of uncertainty, the default is to do what others are doing. This mechanism is appropriate in genuinely uncertain situations where others may have information you lack. But in speculative markets, social proof is catastrophic. Rising prices attract new participants, social proof, who drive prices higher, which attracts more participants. The mechanism is the engine of every bubble. Envy and jealousy. Munger frequently cited Warren Buffett's observation that envy is the stupidest of the deadly sins because it gives you no pleasure while making you miserable. More specifically for investors, envy causes bad behavior. Watching others make large profits in an asset you do not own creates the kind of emotional pressure that pulls people into positions at the wrong time. The investor who re-entered South Sea Company stock at the peak because others who had held it were wealthier on paper than he was. That investor was operating under the influence of envy. Chapter 10. The discipline of patience. A final principle from Munger's approach deserves particular attention: patience. Munger argued consistently over his career that much of the work of being a good investor is not active at all. Most of the time, the right thing to do is nothing. To hold good businesses, to wait for genuinely exceptional opportunities, and to resist the urge to act that markets, media, and human psychology collectively generate. The financial industry creates a continuous flow of noise, analysis, and commentary that implies active response is necessary. Markets move. Experts have opinions. Events occur that seem to demand a reaction. The psychological pressure to do something, to rebalance, to trade, to respond to the latest development, is constant. Munger's view was that this pressure was almost entirely counterproductive. The investor who can sit still, who can hold a genuinely excellent business for decades without worrying about quarterly earnings, macroeconomic forecasts, or short-term market volatility, produces better outcomes than the investor who responds to every signal. The patience required is not passive. It is the active exercise of restraint in an environment specifically designed to make restraint difficult. The market structure, with its continuous price discovery, its constant commentary, and the psychological mechanism by which falling prices feel more urgent than rising ones, is a machine for generating anxiety and therefore for generating action. Resisting this machine requires deliberate effort. Munger and Buffett have described their investment approach as waiting for opportunities they can describe as obvious. Situations where the quality of the business, the durability of its competitive position, and the reasonableness of its price are all clear enough that they do not require elaborate analysis to justify the investment. They then hold indefinitely as long as the fundamental characteristics that made the investment attractive remain intact. The number of such opportunities that appear in any given year is small. The investor who requires activity, who needs to make multiple investments, respond to market movements, and demonstrate busyness, will not have the patience for this approach. The investor who can genuinely wait, holding cash and existing positions while the market generates opportunities that do not meet the standard, will accumulate far better long-term results. Chapter 11. The acquisition of worldly wisdom. Munger used the term worldly wisdom to describe the goal of the latticework approach. Not encyclopedic knowledge of any single field, but a deep, practical understanding of the fundamental principles across the most important fields of human knowledge. He argued that worldly wisdom was rare and therefore valuable. Most people, even highly educated people, possessed deep expertise in a very narrow area and a shallow, easily confused understanding of everything else. The person who genuinely understood the basic mechanisms of psychology, physics, economics, biology, and history, and who could apply those frameworks naturally to problems as they arose, was more capable than any specialist operating purely within a single discipline. The practical process of acquiring worldly wisdom is reading, but reading of a particular kind. Not just reading in your area of professional expertise, not just reading the books that are recommended in your professional context, reading widely: history, science, biography, mathematics, psychology. Reading primary sources where possible. The original works of the thinkers who developed the ideas, not just summaries. Munger's own reading habits were famously broad. He consumed scientific papers, business histories, biographies of historical figures, and works of general intellectual interest at a rate that those who knew him found remarkable. He retained what he read and connected it, bringing ideas from one field to bear on problems in another in the spontaneous, natural way that years of cross-disciplinary reading produces. The time required for this kind of reading is substantial. It is not a commitment that can be made on the margins of a busy professional life. It requires deliberate allocation of time and attention. Munger and Buffett both described themselves as spending the majority of their working time reading and thinking, rather than in meetings or direct commercial activity. This allocation reflects their belief that the quality of ideas is the primary determinant of investment outcomes. Chapter 12. The Partnership with Buffett. Charlie Munger's intellectual relationship with Warren Buffett is one of the most unusual and productive partnerships in business history. The two men were complementary rather than similar. Buffett is warmer, more storytelling-oriented, more interested in the human dimension of business decisions. Munger is more direct, more analytical, more likely to identify and articulate what is wrong with an idea. In Berkshire Hathaway's meetings and correspondence, Buffett would present a view, and Munger would often respond with a single clarifying remark. Sometimes, "I have nothing to add." Sometimes a brief reframing that shifted the analysis. The partnership benefited both. Buffett credits Munger with moving his investment philosophy from the Graham value approach, buying poor businesses cheaply, to the quality approach, buying excellent businesses at fair prices and holding them indefinitely. This shift was transformative. The compounding returns of holding excellent businesses outperformed the returns from rotating through undervalued but mediocre ones by a margin that grows dramatically over decades. Munger's specific contributions to major Berkshire investments are documented in various places. His analysis of See's Candies in 1972, where he pushed Buffett to pay what was then considered a high price for a business with genuinely durable competitive advantages, demonstrated the quality approach in practice. See's Candies has generated returns that vastly exceeded what the purchase price implied at the time, precisely because the quality of the business was as durable as Munger's analysis suggested. The willingness to pay more than pure value investing doctrine would recommend, to pay for quality rather than simply for cheapness, has been central to Berkshire's extraordinary long-term performance. Chapter 13. What the Almanack leaves behind. Poor Charlie's Almanack is now, following Munger's death, a book about ideas rather than a window into an active mind. Munger will not add to it. The speeches are complete. The principles are as he left them. What the book leaves behind is a remarkably coherent account of how to think about complex decisions. Build your mental models broadly, invert before you proceed forward, maintain a margin of safety, know the edges of your competence, watch for the Lollapalooza when multiple forces align, resist the psychological biases that produce predictable errors, and have patience. The patience to wait for genuine opportunities rather than manufacturing activity. These principles do not tell you what to buy. They do not predict what markets will do. They do not substitute for detailed knowledge of specific industries and businesses. What they provide is a framework for the quality of analysis that precedes and surrounds specific decisions, the mental habits and intellectual discipline that produce consistently better judgment over time. Chapter 14. The Final Lesson. Munger spent his career arguing that most people were underinvesting in their minds, not in their professional expertise. Most people invest heavily in that, in the breadth and quality of their mental models, in the rigor of their thinking about how they think. The financial returns he achieved were, in his account, the result of this investment. not of secret information or special access or political connections, of better thinking, more rigorous, more broadly informed, less susceptible to the predictable errors that he had catalogued and described. Poor Charlie's Almanack is an invitation to make the same investment. Not to copy Munger's specific positions or Munger's specific assessments. To build, over time, the same quality of mind that his approach represents. The lattice work takes years to build. The circle of competence takes years to develop. The patience required to wait for genuinely exceptional opportunities takes years to cultivate. None of this is fast, but neither is compound interest. And compound interest is one of the most powerful forces in the financial world. Munger believed that intellectual compound interest, the accumulated returns of building better mental models over decades, operated by the same principle. The work begins today. Or it doesn't begin, and 50 years from now, you are still hoping that the next investment you make will be the one that makes up for all the errors you could have avoided. Munger's choice was not complicated. Neither is yours. Remember, this is for educational purposes only and does not constitute financial advice. These ideas are presented in original language for educational discussion of Munger's publicly expressed philosophy.